We are off to the races. So in chapter 8, we talked about what? Yeah, we talked about debits and credits in everyone. That's like a primary answer is what we call that. A purchases journal. That's correct. So chapter 7, we did the accounts receivables. In chapter 8, we did accounts payable or purchases. It could have been more embarrassing for you. Mark Hale's laughing, so it's got to be good, whatever it is. No, just kidding. I'm recording. It's all good. So that's Sterling having a computer malfunction for YouTube posterity. Lisa's like, okay, I'm out of this one. Now she's in it. No. It's the pause button, Sterling. It's the pause button. Or the mute. All right, so we are jumping now into chapter 9, which is going to talk about cash receipts. And cash receipts are very valuable because it's mo money, mo problems. And cash is the thing that disappears the quickest. So we have to have lots of controls. We talked about internal controls the other day. We're going to go through a bunch of internal controls at the end of this chapter, just because we got to make sure that we do not lose cash. Now, has anybody worked in an industry, retail or a restaurant, where they've had to handle cash before? Yeah, Mr. Pinkston? What'd you do?
Worked at McDonald's.
Do they have any system in place for you taking money? But I mean, like, how did you have to count at the end of your shift what was in the cash register, or was that all done automatically?
Well, I was responsible. You run the cash, you got to be responsible for your
Drawer?
Your drawer, but the managers actually did do the counting because they put it in the safe and everything.
So when they handed you a drawer, is that what they did, or how did it work?
Well, yeah, if you start off in the morning, they'll come and bring the drawer, whatever. But
Put it in.
if it's like in the middle of the day or something, then 9 times out of 10 somebody else was on that register, so they'll come and switch out the drawer.
Now, was your drawer ever short or over?
Yeah, sure. Like it can be over sometimes just because people they don't want the change. Like it could be a few pennies, or it could be.
Now, if it was over or if it was short $50, what would happen?
If it was short $50, then what happens? Manager will go review the receipts and see if there was like any kind of let's see if it was like any meals that were compensated.
Okay. And what about if it was short $150? What would happen?
Well, if it's short once $50 or whatever, like sometimes like when you pay like you're supposed to put like big bills, 50s, 100s, and like in certain parts of the drawer.
Right.
Under the drawer or in certain parts. So sometimes like you be sliding those type of bills and it just might fall in the back of the drawer or whatever. So that can go missing, and those kind of mistakes do happen. But if that's a repetitive issue, then of course you can go under like a investigation.
They think it's you because they have ways of making everybody think that, or they have ways of figuring out who it is and who it isn't.
Either that or you can't.
Or you can't be a cashier anymore, right? Gabby, question. Sorry to put you on the spot right when you walked in.
Question.
At Soup Plantation, I'm serious. We're talking about cash.
Okay.
You're a manager, right?
Yeah.
How do you handle the cash drawer?
Well, we have a PC, which is petty cash.
Okay.
And it usually holds a certain amount. Some places hold like 1,400. Other places hold like 1,100.
What would be the code to get in? I'm just kidding.
None.
And where's the address? No, I'm just kidding.
Well, of course, it's held in a safe, and then we have our 3 drawers. They each hold 300.
So are you a cashier, or do you have somebody else that does that typically?
Well, sometimes I'll do cashier, like if I need to send one of my cashiers home, because the same hours.
And do they get a drawer,
Yeah, they
a
get
separate drawer every time? So you
Separate drawer every
change
single
out the
time.
drawer
Every single
so
time.
that you can count the money from that
Yes.
person specifically? Now, are you in charge of the counting?
I am, yes.
All right, so what protections now? So we're going to move from the person with the drawer to the manager now. What do you need to make sure is happening whenever you do it? What do you look for as a manager?
Okay, so the first first thing I do is when we pull it, we have to be next to them all the time.
So you have to physically be there when the drawer gets pulled.
Yes, and watch them.
Now, what do we call that? It's a control.
Yeah.
Okay? So someone doesn't pull the drawer on their own. Great. It's not micromanaging. It's making sure. Cash, you got to micromanage everything.
Yeah.
Okay? So, okay?
We watch it, and then if they have any voids or we see what they have, you know, and then we have to go into the.
Okay. Any compensated meals or anything? Like comps?
Yeah.
Okay. So we're looking at it from the opposite end of Steven right now, where now she's coming to check up on all those things. Okay? That's good.
And then we get to go into the system. We have to void them all out, you know, and then it's when we pull our X report.
So you have a report that comes up and shows you all the transactions or
Yeah,
something?
it shows all the transactions, and it shows how much money is supposed to be in that drawer minus the 300.
And then you count.
And then and then we go in the back and we count, and the number that they have has to be.
Do they go to the count with you?
They do.
Okay, so now this is an interesting one because my wife would not work at McDonald's. She would work at Soup Plantation though, because she thinks that whenever cash is involved and she's responsible for it, she wants to be part of the count. So this is a control where the employee can feel secure that the manager's not going to pull any money out and blame them for being short. So they can sit there and watch the count happen. Okay, so this is good.
Yeah, because I mean, if that's the case, if you were to take the drawer and the money came out, you know what I mean? Then it's technically you're responsible for it now.
Not them. Yes,
Yeah.
exactly. So
And
that's
the
good.
reason why
Move
they
on.
have to be in.
So is there a window? You said minus the 300. Is that you said the
Well,
the
each
buddy money?
drawer has 300 already to begin
Right,
with.
right.
So that means what's on top of that money is
Okay,
how much
I
there.
know that, but the control is that person has to be there. You have to be with them when you take the money, when you take the drawer out. I'm saying you guys already have a transaction thing that shows you exactly how much
Yeah.
money that person should have had for the day.
Yeah.
Now, we're not gonna talk about going over because like
Steven?
said before, sometimes people leave their change, you know, and I get being over, but what's your buffer for?
Oh,
you
it's
having
5 over and 5 under.
$5
Yeah.
over?
Mhm.
So
So if you go over that, then you're in violation.
That's close.
Yeah.
Oh, that's actually a big over under. Yeah, that is. If cash is off at all, you have a problem, right?
Yeah.
Any variance from what's in the register, and we're going to talk about how to deal with that today. Any variance means something failed. So something's wrong. So $5 is actually pretty lenient because there's a lot of places that it's $1 because someone can pull $5, somebody, that's all right, just write it off. You have a manager that's like, okay, it's $5 off, write it off. Well, if you're pulling $5 every time you're at the drawer,
Well, that gets noticeable.
it gets noticeable, yeah. Now, have you ever caught anybody taking money out of the drawer? You don't have to tell us who it is.
I'm not gonna tell you who it is.
Yes,
have
is
not
that the
caught
answer?
anyone.
No? Okay.
I just heard stories of what people used to do, which people know how to do the system. So, for example, a meal and a drink is $14.13. So what people can say is that, oh, it's $14.13, you know, and then take the money and then pocket it without putting it in the system.
Okay.
So now
people are trying to game the control by not ringing it up and
Yep.
taking the money.
Yeah, and
So-
that's exactly what they do if they do that.
Now,
But
are all your cash registers cameraed? Like, do they have
we
cameras
don't
on them?
have any cameras.
Oh, see, that's interesting. I worked at Sears when I was younger, and every register had a camera above it. And so when you were sitting there ringing someone up and you would type stuff in, it would show up on this camera screen what was going on. So loss prevention, I don't know if you've ever seen this like a convenience store, they could see exactly what you're doing on the register and what's happening where you are. And it was above. So they would see when the drawer opened, if you were pulling money out, all that kind of stuff. They could see everything that was happening. And that's a control. Once again, trying to make sure that fraud triangle that we talked about, everybody has a motive. We have to prevent them from having a means or an opportunity.
But we are going to get cameras, though.
They are getting cameras, yeah.
Yeah, we're going to get cameras. We're going to get a whole remodel.
Good.
Other stores. That's exciting.
So finally, you put it in a safe when you're all done?
Oh, yeah.
How do you know that someone's not going to steal after that? Like, is it out of your hands as soon as it goes in the safe?
Well, yeah. Once we go in the safe, we double count it. Well, we pull out the money first and put it into a deposit, and then we count the drawer to make sure that it equals 300, and then we go and we put it in the safe, and then we lock it. And the reason and how they know that is each individual manager has their own code, so they can see.
See, here's another control.
Yeah.
So they can see who opened the
Yeah.
safe
So once I
and
put
what
it
they were
in,
doing.
Then whoever's the next one to go in and do it.
Yeah.
Because technically, it's theirs now.
Who's they? You're in the
My managers.
Her owner, essentially. Yeah.
My coworkers.
So there's different layers to all this. Now, if we went up the next layer, that person would be, you don't take it to the bank, do you? Or you do?
We have someone.
Okay, so they have someone else come take it to the bank. Notice how we're doing these separation of duties. We've talked about separating things out. It's because every time we get someone else to come do something that the other person is, if the person picks up the deposit that Gabby's done, and she's written it all up and gotten it ready, and they take it to the bank, and the bank says, wait, we're off by $100. Where is that person going to go? Right back to Gabby and say, wait a second, it said there was $100 missing. And then they can figure out where the money messed up, like what happened in this process. So we separate these duties to get the next person to report on the next person to report on the next person. That's how this all works. And we've just kind of watched it go all the way up. Consumer to Steven, Steven to Gabby, Gabby to the depositor to the bank. And that's just how it works. And we've set up this huge cycle of how to control cash. So cash receipts are very easy to go into the existence, right? It's the thing that we can take and just disappear with. There's no receipt. You don't know what happened. So we really have to be careful when dealing with cash. So let's talk about section 1. First off, there's different types of cash, and it depends on the nature of business. So when I say cash, you say, oh, cash. I'm just kidding. Okay, so I was trying to be a cheerleader there just for a second. No, but when we're talking about cash, it's not just greenbacks. It's not just dollar bills. What else could be cash? A debit?
Debit card?
No, not necessarily. But what were we going to say? Checks. Checks could be cash because that means we can instantly get it. EBT, I wonder, you know what, that's a good one. I don't know. I don't think, because I think it operates more like a debit card. So you have to swipe it in order to get it. Oh, you hand it in, right? Department stores receive checks. So checks is a big one. Wholesalers receive cash in the form of checks. So checks and cash are all considered cash. That's what I just want to make sure. When I say cash, we're not talking about that physical dollar bill. We're talking about things, money orders, that's considered cash. A certified check, that's considered cash. Those are things that people could take and maybe just run off with. We'd say, what do they always get in the movies? It's the bonds, the unmarked bonds or whatever. I don't know. They're always like, I want $50 billion in unmarked bonds. And you're like, what the heck? Where do they go get that? So this is what a cash receipt journal looks like. So Elizabeth, you've already got this all done up, right? You ready to go? Oh, she's ready already. Bam, we're good to go. So the cash receipts journal has separate columns for things that are frequently used. So let's just talk about this. We have our description, our posting reference. We have that everywhere. Accounts receivable credit, because that means we're going to get cash in from that, right? Sales tax payable credit, sales credit, and then other. Now this other is what we fill in whenever we have some account that just comes up, and we'll see this. We'll be doing a lot of examples of this as we go.
So this is pretty much the grid of chapter 7, correct?
This is chapter 9. What do you mean this is the grid of? Okay, it's close because in that chapter they were collecting credit. Now we're turning it into actual cash. So like we would have people owe us money. Now what if they came and paid us? Then we'd have to remove it from these things and we would put it in there. So we'll get to a good example, but good question.
No, the thing is, I have the grid for something else.
Okay.
So I have to
It'll work a little bit here. Yeah, so we could start with 7. We can modify chapter 7s. So at the end of the month, we're going to tally up all these just like we have in the other 2 journals. And we're going to tally up all these different accounts. So let's talk about cash sales and sales taxes. We're going to be back at maxed out sporting goods, and let's consider the cash sales entries for January 8th in the cash receipts journal. And let's record some of these as we go. First off, on January 8th, the firm makes a cash sale for $4,500, and the tax rate is 8%. Let's see how we could record this and confirm that total credits equal the total debits. So we would come in and we would make a sale for $4,500. And just like in chapter 7, this would be, chapter 7, it's all credit. This is someone that comes in and pays cash. Okay? We multiply it by 8% to get our sales tax rate. And then we say the person gave us $4,860 in cash. That make sense? We're all good with that? Okay. So it's very simple. Instead of putting that into accounts receivables, as we did in chapter 7, we're just taking the cash for it. So anytime we get cash, where's it going to go? Cash receipts journal. Good job, Markale.
What's the 702 again?
Was it?
What was the 702?
The 702 is, well, it's just, we're pretending there's a transaction there already. Ann could have had a transaction for, she could have come in and paid for her bill. This is accounts receivables credits. So this would have been Ann coming in and paying $702 for her bill that she owes us in accounts receivables, but she paid in cash or a check. So we marked that down saying, hey, we're going to remove part of the accounts receivables, but we got cash for that. Did that answer that? Now let's talk about over under. Sometimes we have a cash shortage or cash overage. I would prefer to have a cash overage because that means I'm not going to get fired, right, Steven?
Well, it depends. Like I said, that can be too far over.
Yeah. Well, then they're like, wait, you're collecting extra money? No.
What about like if somebody like for instance somebody goes there and they buy something they're like, oh, keep the change.
Yeah, but to do is like when they keep doing it either repetitively, then like when you do take the change, put it on top of the register.
Yep.
It'll kind of almost make it look like we're not giving them all the change back.
It makes it harder for the person that has a cash register because they're screwed up at that point. So that's why a lot of places have those like donate your change right here, because you put it Ronald McDonald House or whatever, put it right there because it allows the person at the register to not have any kind of the way I'm trying to figure out how to say this. Don't look at accounting controls as a strict regulation on yourself. Look at it as a way to be transparent. That's what I would keep saying. It's a way to prove that you're doing something right. So you don't want someone to ever call into question whether or not you're doing something properly. So having a way to get rid of that extra and not put it in your pocket is just one more thing. Like let's just say every day, you don't want to encourage the thought that I can make more money at my job by just skimming off some change. Because then what happens if the person's like, hey, why don't you just leave your change? Oh, okay. And then they start pressuring your customers to leave the change. You don't want that to happen. I love Taco Bell because Taco Bell used to always have the dollar sign when you go through the drive-thru. Or the ones that say on the cash register, if you don't get a receipt, what? You get a free meal. Why? They want you to be part of the control. They're literally saying, we'll pay you if you get out of here without a receipt. Yeah, and the reason is that's a control against the cashier so they can't pocket the money. Because the cashier could just type it up and like, oh yeah, go ahead, 1463 or whatever you said earlier. And they could take the money and pretend like they're putting it in there, and they're not, and you don't get a receipt. Because the only way you get a receipt is what? Huh? The only way you get a receipt is, well, if you type it into the computer. And if you type it into the computer, you have to void it if you want to get rid of it, which means someone's going to be able to track it. So that's why they say, make sure you get a receipt, and if you don't, your meal's free. Taco Bell shows the amount that you're supposed to pay down by the drive-thru. The reason they did that was because you're supposed to see what it says there, because if it said 406 and they're asking you for 625, you're going to be like, wait, it says 406. You're checking on the cashier. And so that's why they do these things. And in the grocery store, when they have the whole thing sitting up there and you can watch everything bleep, 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 bleep go through, it's a control. They're trying to keep people from not just swiping stuff around and putting it through. You're supposed to watch everything that goes through. So it's interesting how companies almost employ us to be part of their accounting control system. So occasionally we have errors that occur when we're making change. And when errors happen, the cash in the cash register is either more or less than the cash listed on the audit tape. Now, if you, Gabby, had a cashier who was consistently misplacing $20, what would you do?
Well,
Like let's just say they lost $20 one night, but they gave you the money back. They said, here, I'll just pay for it. I don't want to get in trouble. And about once every week that's happening.
Well, see, we have a thing where if you do that a lot, then you have to get writing up for it, and you get three chances. On your third chance, then you terminate it.
Right.
You don't. Why does your drawer keep missing $20? $20 in it.
It's a big deal. You get written up instantly. It's okay, so they've got another control in place. If you're missing, you get written up 3 times, gone. It's a good control because you know what? Someone's either A, incompetent, or B, stealing. Those are the 2 choices. And people are like, I'm so sorry, I didn't mean it. No. They're doing one of the 2 things, incompetent or stealing. That's just what happens. You don't make 3 mistakes with that big of a issue. All right, so we want to have it on the audit tape. This is just like an audit trail, a receipt at the end of the day. Do you guys print out a big long, Gabby at Soup Plantation, do you guys print out a big long thing at the end? That goes with the deposit because it proves here's all the cash that went with all these transactions. That's part of that audit trail. They staple it, they do all these, everybody has a different way of doing it. A lot of waitresses at the end of the night will come up and they'll put together all their tickets that they've been keeping, they staple them together, they put them in, and that's like, hey, that was my pull for the night. That's to improve the audit trail. So when we record a shortage, we have this new little account that we're going to talk about called cash short or over/over. And this just is there so we can kind of fix the little issues that we have. Now, if we were short $18, I'd be upset as a business owner. I'd be like, what? We don't want to be that way. I'd be like, $18. How are you off $18? Those are things, when you start seeing 20s and you see 50s, you're thinking people are either A, pocketing it or not taking it. So solid numbers are always bad because that's one of those indicators. Were you going to say something?
Well, sometimes with the shortages, it don't necessarily mean somebody's taking it or not leaving it. Sometimes it's, like either their customer is not satisfied.
Right. Customer doesn't want to pay or what?
Either they paid and food, they didn't like the food that's undercooked or something like that, and you just, like instead of a free meal, you just like refund it.
But that's not going to be considered a shortage because you're going to have a void at that point. So this would be something that the drawer's done and you come in, the drawer's different. What were we going to say?
And that could also be, but also like on the POS system, we also have exact cash on the screen. So what you could do on accident is put it in and then press the exact cash. And sometimes if you have new people, they don't know what to do in that type of situation because their trainer's not training them correctly. So that could come back.
So there's no change, or they put in no change, but they issue change.
So it's saying that it has as much cash, but when they really have $20 under, you know what I mean?
Interesting.
Yeah.
So yeah, there's a bunch of different things we keep track of. I don't know why I just lost my remote. There we go. Debits are not normal. Balance of the other accounts is a credit column. So debit entries are always put in brackets. So we have that. Now let's record a cash receipt on account. So let's consider that Ann, we're coming back to that one James is all worried about, has $702 that she owes, and she's going to come in and pay it. We would put in that accounts receivables, credit, and we would put in $702 in cash. So we would show that she came in, she actually paid her debt. So the check amount is entered, and the accounts receivable, credit, and cash debit columns. Now, sometimes we have a discount. We had talked about this. Somebody asked about that net. I can't remember who it was. But sometimes we offer discounts for paying early, or we have a sale or something like that. So Maxed Out Sporting Goods does not offer cash discounts. However, many wholesale businesses offer cash discounts to customers who pay within a certain time period. These are sales discounts. And businesses with many of the sales discounts add sales discounts debits column to the cash receipts journal because they're going to be doing a lot of this because there's a lot of companies that will take advantage of that to save money. Now, if we have money that's not being collected, sometimes we roll that into a promissory note. Does anybody know what a promissory note is? What's a promissory note? Yeah, it turns into a loan. So a note can be synonymously used with loan. Note, loan, loan, note, same thing. So what we want to do is, if we're getting somebody who's getting to 180 days out on accounts receivables, A, it looks like we're never going to collect it. And B, it's just bad business practice to have some, it's not an accounts receivables then, it's not a current asset, it's something that's going to take longer. This is one of those things that we would probably approach the company as they're getting to 90 days if we were going to be lenient about it and say, listen, we'd like to do a note at 9%. Does it say what percentage it is?
Value received. But for the bottom.
Value received or interest at 9%.
Yeah, interest at 9%, exactly. So we want to do a note, $800 at 9%. Whenever we talk about percentage, is this per month? No, it's always annually, okay? So 9% annually. How do we figure out what the percentage is for each month when we have to do a calculation for this? It's really simple. We're going to take 9% or 0.09 and divide it by 12. That tells us our 12 months interest rate. Now will give us every month how much we should be charging in interest, or the rate with which we need to charge for the month.
So you do it as 12 months, even though you might have said for 6 months.
Okay, but this is 9% for 12 months. They're only going to pay 4.5% because it's only for 6 months. But every month they're going to accrue interest. So the first month we're going to take 800 and multiply it by 0.09 divided by 12. I don't have a calculator. Anybody? Should have brought all the calculators in. Everybody's got laptops open. Yeah. Whoop. iPhone to the rescue. 0.09 divided by 12 equals 0.0075. I knew it was a good number. So this would be 0.0075 per month. So the first month, at the end of it, we would multiply 800 times that, which gives us $6. So they made $6 of interest for 1 month on the 800 bucks. But the next month, it's going to be $806 times 0.0075. So we'd say 806 times 0.0075. Now they're getting $6.05. These guys are making some bank. Okay? And so on it goes. But they're charging for the cost of not bringing in the money. And so you would go 6 months out, but they don't owe 9% every month. That's what I'm just trying to make sure. Sometimes people get that confused. They're like, 9% a month? That would be an incredible way to make money. You'd be rich really quick with that.
They do it. No. Private one banks.
You can't do 9% a month. Well, I believe in our state, at least, usury is at 24%. So 24% a year, which is 2% a month, is the max limit. Past that, it's called usury or loan sharking, and it's illegal. So there has to be very special circumstances, or it's a business deal or something like that, but it has to be written up. It's kind of tough. But it does sound like credit cards, right? Daniels? 29% is usually the credit card rate now. But that's because they lobbied Congress. We'll let them have what they're going to have there. All right, so on July 31st, Max Out Sporting Goods recorded a general journal entry to increase notes receivables and decrease accounts receivables for $800. So if we issue this promissory note to someone and we say, hey, it's not going to be in accounts receivables anymore, we have to take care of that in the general journal. We have to show that, hey, we're going to get rid of some accounts receivables, but what we have now is a long-term notes receivables instead of short-term. So we're just going to switch those two things, and we're going to say, hey, we received a 6-month note at 9% from Stacy Fairley to replace an open account. So we're going to get rid of her accounts receivable account. Now, if you were doing this in your company, you're Max Out Sporting Goods, and Stacy can't pay, she comes to you and you work out a promissory note. And then 2 days later, she comes in to use her credit card again. What are you going to do? What? You said something. What are we going to do when Stacy goes to buy something? No, she's going to use her accounts receivable account. So we just moved everything from her accounts receivables into a note. Now she comes in 2 days later and says, hey, I want to put this on my charge account. It's going to fall under this, but this is now 0.
So she pay something on her promissory note, let her use it.
What would you do, Gabby?
Because this has an interest, right? I mean, we already
It has interest.
paid what's already been bought, and she buys something new.
Well, she hasn't paid it. She's just transferring it into a note, right? So now it's a 6-month payable note with interest, but now she can come in and use her accounts receivables. What would you, Kendra?
I would pay like within the 6 months. So
No. If you were the owner and Stacy came in to buy something on her accounts receivables after you just did this 2 days before, you're like, listen, I know you can't pay. Tell you what, let's turn it into a note. I'll charge you 9% interest. You can pay back in 6 months. She does that, and then she comes back in 2 days later with her account and says, hey, put it on my account. What do you do? You're so nice. I tell her to go pound sand is what I do. I'd be like, pay your debt. I'm like, your account is 0. I mean, you don't get jack until I get my money back. I'm already screwed another $800. I'm like, yeah, that's just throwing good money after bad at that point. Like, you know what? You become a valuable customer when you pay for what you bought. That's what I would say. But that's just me. Okay, that's my opinion. You guys can go out of business. No. So the asset account notes receivable was debited and the accounts receivable account was credited. So we have the amount owed of $800, 9% per year. They're going to do this for a 6-month period rate, which is divided by 2. So we come out with 800 times 4.5%, which is $36. So let me clarify what I was saying before, Stephen. This is if we call this compounding interest, and they're keeping this a simple interest for us right now. So this is what we're going to get into in further chapters, but right now they just want to keep it. So we're just going to take 9%. We could divide it by 12 and then multiply it by 6, or we could just divide it in half. So they're doing a little bit of math there.
Yeah, that's what I was asking.
Yeah.
That was, so what you're doing is gonna break it down.
This is called compounding, where we're going to put interest upon the interest every month, and we're going to do this in further chapters. This is kind of how it works in reality. This is a very simple version so we can learn the concept.
So this would have a completely different cell, would be compound interest, or would it be a different
You're going to recalculate the interest every single month this way, but for this chapter, we're not going to do that. We're just going to have one interest calculation for the period of time, and we'll work on that when we get to the problems. So they'll owe $836 or whatever her name is. Stacy will owe $836 instead of $800 in 6 months. So you'll notice that there's many types of cash receipts in this journal. And let's take a look at the last one shown. On January 31st, the customer pays the full amount of the note. Right here, she's going to come in and pay for it. And the receipt of the principal amount of the note plus the interest can be recorded in the cash receipts journal. Notes receivables, right here, is credited for the $800, and then interest income is credited for $36. So it doesn't all go into a notes receivable. Because she only owed us $800, we have to call this income. And that's great. And we can always confirm that this is working because if we add these two together, notice that there's only one date on the left and then there's a blank spot. That means this is a compounding entry. It means there's two of them to it. This number equals these two together. So that's how we know these together. And then when we tally everything up here, these should all total, and we'll get to that in a second here. So the interest in the credit section, perfect. Now we want to post from the cash receipts journal to the subsidiary and general ledgers. We want to take this and put it over to where it belongs. We've done this in 2 chapters now, and we did this before in Accounting 101, so we should be getting good at putting this into a ledger. We're going to take these total amounts down here, and these column totals are posted to the general ledger. So we'll do that by taking this, and we come over and say, okay, in cash receipts 1, so CR1, this is our indicator now of a cash receipts journal page. So we know that when we transfer it over here, we'll say on the 7th, here's Ann's accounts receivable account. We got from cash receipts 1 a credit of $702, and it brought her balance down. There's that. Okay, let's take our 10-minute break, and we're going to come back and talk about cash payments. All right? So pause, and we will come back. So we are back. Had to go to my second Diet Coke for the day. Keep pepped up for you. Gabby's looking like she needs Diet Coke. All right, let's talk about cash payments. So we want to record cash payments in the cash payments journal. And we want to post from the cash payments journal to the subsidiary and general ledgers. Now this is the same thing that we just talked about, but now we're paying. So we're going to do this really quickly, and we're going to talk at the end about petty cash and about internal controls. Cash payments journal. You've got this one written up already, right, Elizabeth? Okay, good. So if we were to go in and pay our January rent in cash, on the other accounts debit, an expense is always a debit. This is correct. So we would put down rent expense. Notice this is a debit, $1,500. The cash is getting credited $1,500. So we're just saying we paid in cash $1,500. There are certain things that we do frequently with cash, but not everything. And we have now a CP1 cash payments journal. Right. So cash payments journal would be recorded as a CP1 right there, and we would take that, move it down into the appropriate ledger account when we post it. And that's from the cash payments. So this little confusing slide right here. Lisa, tell me what the standard deviation is of the cash account versus the purchase discount. I'm just kidding. It's not a stats class. But we just want to see how all of these little things are interacting. So we have our journal, and we have a ledger, and a ledger. We're going to show that at the end of the month, we're going to take everything from the accounts payable debit. We're going to transfer that to our accounts payable ledger, and then that's going to give us a different balance because we just took off $13,750. Once we're done, what do? We go up here and we put that we posted it in there with the little brackets. That's how we know that we transferred it. We're also going to take our purchase discount credit, transfer that down to that, put our 504 in here, and then our cash account is going to go back and forth from here. We're going to post everything that we paid from there at the end of the month, and it gives us a balance. So we do this so that it makes it easier. We don't have to do multiple transactions in the general journal every time we do cash. And we're going to end up with a really nice cash payments journal, which also gives us an audit trail. Because if I want to know if Kendra paid something in cash, what can I do? I can pull up the cash payments journal, and if it's not in there, I'm like, Kendra, I told you to pay cash. What would you say? I wanted to get those bonus miles on my Southwest card, right? so she would have forced us to get that. She's going on a vacation. All right. So let's talk about petty cash. Anybody in here ever had to deal with petty cash? Yeah? You deal with petty cash. You got one big petty cash drawer, right? It's a pretty big drawer, actually. Did you say 1,400?
I know ours has 1,100 in it.
1,100. 1,100. So petty cash is interesting because what is the purpose of a petty cash account?
Petty cash is to have the extra cash in there for example, if you need any type of office supplies, we can pull it and then you have to write it down in the receipt.
So if they need office supplies, she can give petty cash to somebody really quick. They can go get it and bring back a receipt.
Yep. Or we can write some if we're missing out on some.
We need burger buns. Go buy them at Albertsons, right?
Or we can buy presents for
Presents. Yeah. Wow, they're getting really lenient with their petty cash. I need this Michael Kors bag. Okay. Petty cash. I think that new iPhone 6 is looking mighty good, petty cash. What do you think? That kind of thing? So what we get is vouchers. And typically, do you guys use vouchers? Yeah. So you have to have a voucher. Are they all numbered? Yes. Pre-numbered petty cash vouchers is a good control because it means you can't be using the same one. They're already pre-printed. People have to handwrite on them. It makes it so that you can track what's happening. And typically you want to know what's going on, or if they get the cash, they bring back a receipt and you fill this out? Mm-hmm. Yes. Staple the receipt to the voucher saying we spent this much on petty cash, and you should be able to go through it. Now, there's usually one person in charge of petty cash. Is that the case at yours, or is it just managers?
Yeah, managers.
Okay. So typically in an office building, you're going to get Sally, the secretary or something like that, who has a petty cash drawer that's locked that they can pull out and they can issue petty cash as needed. And every month we look at it, and let's just say there's $150 in there. Every month if they use some petty cash, they just want to make sure that at the end of the month they put enough money back into it that it equals 150. So there's 1,100 is a fairly large petty cash account, I would say, for a typical small business. But we just want to make sure that we have this. So we have a voucher number, we have a signature by someone, we have the date, it was approved by who, we have the initials who was approved by, the date they approved it, and the amount written out. And having a written out amount, I don't know if you guys do that on your vouchers where you have to write it out like a check.
Yeah.
Yep.
Well, yeah.
The reason you do that is so that somebody can't say, oh, well, I thought it was a 7, it was a 1. You write out so everybody's on the same page. This is how much money was done in both number and word form. Now, replenishing that fund. They have a fund of $175, and that's what they should always have. So they need to replenish it if it gets low, and they replenish that by going through. They want to first make sure that their internal control was taking place, that all the vouchers were done. Somebody reviews all the vouchers, says, yes, this is an appropriate purchase. The manager will go through and do that. The money adds up, and they're not writing checks to cash. A lot of people used to do that, and still, when they get lazy, they just write a check to cash. And they're like, oh, this is petty cash. That's not how petty cash works. Okay? Petty cash should be cash sitting in a drawer, sitting there, ready to be used, not that you're going to go take to the bank. If you're going to write somebody a check for them to go purchase something, what do you do on the check? You don't write it to cash. Who do you write it to? Whoa, wait, what was it? What did you say, Lisa? To who it's to. So if you're giving it to an employee to go get cash, you're going to write it to the employee. That gives you an audit trail. And you're going to put in the 4 in the memo area, this was for cash to go purchase X, Y, or Z. So so we don't just write something to cash. We want to put down who it was to and why they were getting it. So we want to use the petty cash only for small payments that cannot be conveniently made by check or credit card. In fact, we don't even have petty cash at this company. We have a petty cash credit card. So they won't even let it be cash. They want you to go out and spend on the credit card because they instantly get a receipt. It has to be approved. We only have a certain amount every month that we can spend on it, and every month they pay the bill and it's replenished. So that's their way of dealing with petty cash. It's a very interesting way. But there's a lot of things now that take cash and credit. You know, we could just go and just do that. That used to be really a lot rarer, I would say. It's kind of fun though. You go in and it says CCSD on the credit card, and they're like, "Who are you?" And I'm always like, "That's me." They always take that as the verification. I'm like, "That's not even a driver's license." So, but you limit the amount set aside for petty cash to the approximate amount needed to cover 1 month's payment from the fund. And typically, we don't know what it is. If we knew what was going to be typically needed, we would just write the checks out and pay for things in advance or have everything ready. But these are usually for like, what does a typical month entail when we have to do random expenditures? And then we want to write petty cash checks to the person in charge of the fund, not to the order of cash. We already covered that. That's an important one. Also, we want to assign one person to control the petty cash fund. This person has sole control over the money, is the only one to authorize and make payments from the fund. Even though at Gabby's location they have all the managers do it, it's really good when you have one person that has access, because then when you go to audit it, you know one person made a mistake. If something is wrong, you can find the person very quickly. The petty cash issue at Gabby's work is, how many managers are there?
There is 4 of us.
4. You got a 1 in 4 chance, and I bet it's Gabby. No, I'm just kidding.
I'm just kidding. But we count it in the morning, the manager in the morning.
Mm-hmm.
And then the manager at night.
They just have more controls on it and how to deal with having multiple people have access to it. But you want to keep petty cash in a safe, in a locked cash box, or in a locked drawer. Everywhere I've always been, it's a locked drawer with a safe inside. So there's 2 things. It's like a little tiny, safe with a key to the drawer that locks. Most offices have locks on their bottom right drawer right here, so you can just put it in there. And prepare a petty cash voucher for each payment. The voucher should be signed by the person who receives the money and should show the payment details. So when you get the money, do you just hand people cash before they leave? You fill out the voucher, right? And then when they come back, you get the receipt from them, staple the voucher, get the change. Everybody's happy in this land. Now, let's talk about some internal controls, the routine controls for cash. the internal control over cash needs to be tailored to every business. Each one's different. So McDonald's might have one way that they deal with money, whereas the San Diego Zoo has another one, SeaWorld has another one, Soup Plantation has another one. Anybody that takes cash, what's an internal control for cash here? Has anybody tried to pay in cash a bill? Has anybody tried to pay like a monthly payment in cash here? Who'd you have to take to? You put it in an envelope. You put cash in the mail? Wow, I wouldn't do that. I'm not a cash in the mail person. But who do you take it to?
I usually take it to the financial people if it's,
Do they have somebody that normally takes it?
yeah, if it's not the, yeah, no, not George, the financial people. They write it for receipt.
I was like, George is getting written up. No. But do you normally have one person from financial aid come out and do it, or is it either of them?
There's two.
So have you given cash to Phyllis?
I usually do it to the guy.
To Scott. That's because Scott is typically responsible for taking the payments, especially in cash. So, yes. I get people sent back to me all the time like, you sent for me? I'm like, no, that was probably Scott Massey. I'm like, you got to go to the other guy. But it's one of those things where Phyllis can take the money, but Scott's usually in charge of the money. But they have to shift, every once in a while he's not here, so she's the backup. But he's the one, I think, primarily responsible. I don't know that. I just see everybody always goes and makes their payments to Scott. So I'm sure that's one of the internal controls that they have where he's solely in charge of picking these things up. Unless he's not here, then they have someone that comes through and probably operates that whole process. So we want to take a look at a couple steps here. First, we want to have only designated employees receive and handle cash. This is very important. Can cooks be registered people at Soup Plantation? No. Why? They're all felons. No, I'm just kidding. I'm just kidding. That's why they're line cooks. No, I'm just kidding. It's because they're not trained in it. They don't have the process, and they're not responsible at that point. In fact, I bet the cooks probably can't even log in to get into the POS, correct? Or can they?
No, they can. But that's how they have to log in.
No, but can they log in to do cash register stuff? That's what I'm saying. Like, everybody comes in, logs in the POS for timing in, time out. But whether or not they can get a drawer and then start doing transactions, no, they can't because they're not designated as that person. So designate employees that can receive and handle cash. It limits who you're going to have to deal with. Okay, already we're starting to shrink down the control. Okay, now instead of 500 employees, now we have 30 employees that we have to control with cash. Number 2, keep cash receipts in a cash register, a locked cash drawer, or a safe while they're on the premises. So whenever cash is out, it's not sitting on a counter. Someone's with it. If you walk away from it, what are you doing? You're putting it in a safe before you go. You're closing the drawer when you go. I love watching those top 20 shocking videos. And they always have the idiot that comes in the supermarket and is like, hey, could I see that over there? And the guy's got the drawer open, and as he goes over to get something, the guy reaches around really quick and grabs some money. You're like, he grabs a bat and beats the crap out of the guy or something. It's like, come on. But the person didn't follow the shut the drawer on everything. One of the things that's not cash, but we have private student information in our offices. So you'll notice whenever any of us walks out of our office, we shut the door. It's always locked. It's part of our control on student information. Same kind of concept. If you have cash, you don't leave it out. You put it away, you put it in a safe. Gabby, if you were to close up one night and not put the cash in the safe, what do you think would happen?
I think that
Like you left, let's just say you left $5,000 out on the counter and you went home. The next morning your boss shows up.
well, he would be mad. Because
Why would he be mad?
Because,
What if he got there and there's only $2,000 on the counter?
then it's on me, and I'm the last one who did it, so I'll be the one that's responsible for the
It's a big deal.
1,000 that's lost.
All right.
I have to pay it back.
Have to pay it back or you get fired. One of the two.
Pay it back.
Yeah. So you want to make a record of all cash receipts as the funds come into the business. If someone comes in and pays cash, you're like, oh, I'll write up a receipt later for that. They're coming for you, Gabby. You can't do that. You have to do, whoa, I'm going to sneeze. Oh, excuse me. All right. Sorry, YouTube. All right. I just heard that. I should have done a live stream for Domingo today. All right. Excuse me. But when the cash comes in, if you don't write it down immediately, when are you going to remember what happened? You know, you're in the middle of a bunch of transactions. If you're taking a bunch of money, you're like, oh, who brought the money? No, you have to write it down immediately. Check the funds to be deposited against the record that was made when the cash was received. So when you're taking the deposit in, does the deposit slip that was prepared match the report that Gabby wrote up on how much cash was in there? The employee who checks the deposit is someone other than the person who receives the cash. That way you have one more little separation here. One of the things that was interesting, did I already tell you about the account at my school when I was a senior class treasurer? No. So I got nominated to be the senior class treasurer in high school. My student advisor said, listen, you have to pay attention because the school controller or accountant lady, her kid told me she has dyslexia and she's always screwing up deposits. So you have to be on top of everything. And we were like $800 negative in our class account. So we had all these awesome fundraisers put together and everything, and we started depositing money. And like 120 bucks would go missing. So I'd be like, hey, I had everything photocopied. Like if we had cash, I would go photocopy all the cash. And I had everything, like I was really anal about it because my advisor had told me you have to have everything documented. So I would go in, I'm like, hey, you messed up the count. No, you messed up the count. I'm like, no, look, I've got cash all counted out here. And I would show her this was the photocopy of everything I brought in. And we're short $120. Oh, let me fix that then. So she'd go in and fix it. So I had to do this multiple times. And then everything just started clicking. Like I would never get anything, like any discrepancies. Well, we ended the year, we had so much money left over in our account, we had a big senior class breakfast. We had everybody come in, we had it catered, and we had valedictorian speeches or whatever, like graduation speeches, and we just had fun for a half day. And it was all catered, it was awesome, but we had so much money we didn't know what to do with it. We're like, we're leaving, we might as well spend it on something. A year later, that lady got arrested for embezzling. And so what she was doing was no one was controlling. She was the one receiving the cash and then depositing the cash. So nobody was checking up on her. And when it happened, I'm like, aha! That explains so much because I was continuously checking up on what our deposit was, and she would get it in, and everybody else was just thinking, oh, I'm giving it to the school controller. I don't have to think about it after that. We're just giving the money in. Fortunately, I had an advisor that had said, you got to watch this person.
You got her fired.
I didn't get her fired. I didn't report it, but it started something because they were all looking at like, why is this all wrong? And it got through because we were like, how did they go from negative to positive? And I was being really anal retentive, and I don't know if it was my advisor, but she was adamant about this was a problem, and so she was big on that. Also, deposit cash receipts in the bank promptly. In fact, you want to deposit the funds intact. The person who makes the bank deposit is someone other than the one who receives it and records the funds. So we don't want cash to sit around. When cash sits around, guess what? It has a way of just vanishing. Somehow, it's this weird oxygen that touches it and poof, it's gone. Okay? So if you leave a $100 bill on the counter, it's probably going to be gone soon. You don't want to do that. You want to enter the cash receipts transactions in the accounting records promptly. Same thing. You got to put it in right then. You want to make sure every day we do a cash receipts journal. Every day we do a cash payments journal. We want to make sure that we're done with that. And have the monthly bank statement sent to and reconciled by someone other than the employees who handle, record, and deposit the funds. We're going to go into bank reconciliation. And I just want to explain that doing a bank rec, it can be one of the most frustrating things, but it's also the thing that confirms everything is what it was reported to be. So once you get good at bank reconciliations, which we'll go over that here. We'll do a lot more of that in QuickBooks when we take the QuickBooks class. Yeah, James, you already took QuickBooks, didn't you? Yeah. You get your bank statement. The reason you get a bank statement is to do a bank rec, and I showed everybody how I like to do a bank rec, which is a little bit, it's a little art. There's a lot of science to it that we're going to learn, like procedure. But you can get better at how you do it just based upon how you want to take and match everything. And QuickBooks is a fantastic program that allows you to see this is how much money I started with, this is how much money I ended with, and I have to go through and make sure all my transactions in between match, and then I should, because it's math, at the end of the month, have the same number. And if you don't, there's a problem. So you have to go find the problem. And James, he had to take hours to find his problems. No, just because there were some people that once, it's so funny too, because on a bank reconciliation, you'd be like, I'm missing 15 cents. And you're like, it can't, it's so funny because you'll see people get frustrated and they'll be like, it's just 15 cents. But if you're a good accountant, that 15 cents just starts eating at your back. And you're like, oh, I couldn't be off by 15 cents. I know it's got to be math. I got to have it somewhere. So you got to go find it.
Monique and I almost went crazy.
Yeah, Monique and you. That's all right. You guys were a little. And I think I found it really quick, didn't I?
Yeah.
Yeah. They were working for hours on something. I went over and I'm like, whoa, look right here. And whoop, there it was. Monique's like, I can't believe that. Anyway, they had been working for hours. They didn't want to have to come and ask me for help. But you get better. If you guys become accountants or you get into a management position and you start looking at bank reconciliations, you get a lot faster at it. The more you do it, it's just one of those things that you can start spotting like, okay, this would probably be where a mistake would happen in the bank record. And it's, like I said, there's a lot of art to it, but it's math. So there's a definitive science behind what's going on. You're just calculating. And then there's a lot of art as in where to figure out what's happening quickly. Let's see here. We also want to, for payments, make all payments by check except for payments from special purposes cash funds, such as petty cash. I would even argue nowadays we want to do a lot of it by credit card. Cash is fantastic, or checks are fantastic, but more and more businesses are going to credit cards. And one of the benefits to using a credit card is when you swipe it and it goes through and processes, your online banking service pulls it directly into your accounting instantaneously. So as soon as it reconciles that night, the next time you update, all those transactions come in and you just put what accounts they go into. And QuickBooks is fantastic, and a lot of accounting is, because it'll start memorizing, oh, every time they spend money here, it goes to this account. And so after you train QuickBooks, doing your accounting, it's like you get really lazy because you're like, well, why doesn't it just know what account to go into? And it's because it's a computer. It can think and it can analyze how many times you've done something, and it kicks them out the right spot. Issue checks only with an approved bill, invoice, or other document that describes the reason for payment. Have only designated personnel approve and bill invoices. And have checks prepared and recorded in the checkbook or check register by someone other than the person who approves it. Are they going to give us the 2 people to sign it? Yeah, have still another person sign it and mail the check to the creditors. A lot of times you'll see check is not authorized if over $5,000 without 2 signatures. A lot of companies will take that control and say, listen, if they do one, I want to see the second one also. I want to, at a certain point, 2 people have to authorize the payment. Use pre-numbered check forms. And all of this is funny because it all sounds so basic, right? We're like, yeah, this is common sense. You'd be so surprised how much common sense goes out of people's minds when they start a business. It's just phenomenal. During the bank reconciliation process, compare the canceled checks to the checkbook or check register. The person responsible for this should be someone other than the person who prepares and records the checks. So the person that does the bank rec should not be the person who writes the checks. It's important because you're having that person check up on the other person. Finally, enter promptly in the accounting records all cash payment transactions. The person who records the cash payment should not be the person who approves the payments or who writes the checks. So it's a separation of those things. So let's talk about this whole bank reconciliation, deposits, and all this kind of stuff. Has anybody been responsible for making bank deposits for the company? You don't do that, do you, Gabby?
We do deposits. At the end of the night, we.
Do you take it?
Do we take it?
Do you fill out the deposit slips? Yeah. Okay. And then have you ever taken it to the bank?
No.
Okay. So they have someone, they won't let her do that part, right? They want her to prepare it, and they're going to have someone else come and do it. In our church, they do 2 people that count tithing all the time because they don't want any but one person ever to be threatened by the thought of stealing that. So they always have to have 2 people count, and they have 2 people drive to the bank and deposit it. And it has to go in that same day. So they have like a night drop that they do. So on Sunday, everybody comes, everybody makes their tithing payments or whatever, their donations. They have 2 people stay afterwards who are, one person's designated as a financial person, the other person just sits there and watches essentially and just verifies. They wrap it all up, they seal it into a bag, they both drive to the bank, they deposit it, it's over. 2-person integrity, 2 deep. That's what you call that, right?
Yeah.
But if they don't have that, they don't count it. They don't do it. They put it in a safe and they wait till they have 2 people that are able to do that. Because there's a lot of cash, especially like in a church donation. People are just giving money. So you want to make sure there's a lot of integrity there. And only certain people, we have little tithing envelopes that they do that are sealed. And so only certain people are allowed to take that. So it's kind of known like, hey, you only give this to like our bishop or something like that. And then only certain people are allowed to open that. Like you're not allowed to just go bust open some tithing slips. There's a whole procedure to that whole thing. So let's talk about how we endorse it and then reconciling. When we write a check, we endorse a check, we prepare a bank slip or a deposit slip, and we maintain a checking balance. This is an old school, I don't know if anybody's ever seen these, the old checking books where you have the 3 on the side, this little receipt tab here, and go 3 down, and then you have the check over on the right. We always start with our beginning balance. We put in the date, who it's to, and what it's for, the total of the check, and then at the end, what our balance would be afterwards. So we tally these. You do this? You like that? It's so simple, isn't it? Nowadays, we get lazy because the bank does all this. As soon as we swipe our credit card, it tells us instantly, hey, this is how much money we have left. This was back in the day when I was a boy. We had to do it this way. You what?
Now we got online banking.
Yeah, online banking is like, what? These people were so primitive. I bet they ate with forks. No, I'm just kidding. So they cooked with fire. So, and we would fill this out, pay to the order of. Now, these are all important parts, and I was laughing as I was preparing for the class. I was thinking, I honestly can't remember the last time I wrote a check. I don't know if you can, but I did payroll checks, but like even then I didn't really write it out. QuickBooks would just spit them out, but I can't remember the last time I wrote a check. I don't know have you ever written a check? You remember last time? So this is kind of old school. We're kind of moving away from this. It's become very digital.
So you don't get paid for 3 days and you eat groceries that Friday night?
Yeah.
So you float a check out there?
You
Knowing that you're going to get paid Monday?
Well, we'll talk about the float because they don't float anymore for 3 days. It's 24 hours with checks now. And that was something passed 2 years ago. So the Federal Reserve now cashes checks within 24 hours. Because on any day. Any day. They'll do it now.
I recently wrote a check for groceries, and I did it for like maybe on Saturday. And it didn't actually debit out of my account till like that Tuesday.
Well, they're slow. You're lucky. Because, well, that might mean that they're not putting it together and sending it off. See, there's a lot of different things that might mean their controls weren't in place to take care of it over the weekend. There's a bunch of different things that could be happening at that point, but everything's becoming pretty digital pretty quick where, like right now, do we even have to take the check to the bank?
No. Go to ATM.
Do you have to go to the ATM?
Take a picture of it.
You take a picture of it with your smartphone.
What app is this?
It's any bank now. Who do you bank with?
I got a couple banks.
Chase?
Well, no, I got
Bank of America? They'll do it. You just go and deposit on the app and you front and back picture and you're done. Yep. You just got to take a picture of it. It'll come up and it'll say, we think that it's for this amount. Is that correct? You type in the right amount and boom, it's done. That's all they care about. Yep. You got to go into deposits. And they'll take, so you can just take it. You don't even have to take it in anymore. And it's because they can do these things so quickly now, they're going to just digitize it anyway. When you give them the piece of paper, they're just going to send it through a scanner, and then they're going to shred the document or send it back off to you. And so they're like, why not just let the person take the picture? And what happens when you deposit with a picture? If you need to look up the record, they got a picture of it sitting on their website now because you took the photo. So you've got a copy of it. Markel's like,
Is it better for you to, if you do the photo, is it better for you to keep that for your records or to
I don't think there's any need to keep the check after that. Once the bank has a record of it, you're just going to probably go. I mean, you could, but it's what?
I think it's still good to keep.
James likes to keep it. I like to get rid of paperwork, so I figure if it's digitized, it's digitized. But James wants to be able to show that in court. You can handle the truth, and he throws it down. All right. So this check is a negotiable financial instrument. What does a check essentially say? It's saying I promise to pay X person, or it actually doesn't say that. It says this person's entitled to this amount of money from my account. So, thank you. This person is entitled to $1,500 written out, $1,500, and I don't know why, but I always put no 100, like 0, for the rent from this bank on this account number with this routing number. So we know that the first 9 digits are a routing number. I don't know if we know that. And the last 10 digits or 9 digits, depends on the bank, are the account number. And we can look at this before we write another check. We can go down and say, okay, we're going to transfer the balance amount down to here, do the same process, and we're all through. So the balance is brought forward continuously.